why then doesn't the Fed just commence with the easing cycle and start with a blockbuster 50 basis point cut? I think it's really down to these slight minor technicalities, if we call them that. So first, despite this clear weakening of hiring momentum, which I think Jerome Powell himself clearly acknowledged, there are still pockets of strength within the economy. Personal spending, for example, is still strong. The unemployment rate ticked down again in August, but also, as I mentioned, core inflation surprised the consensus to the upside yesterday, coming in at around 30 basis points month on month.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance. Welcome back to Converge Market Update for September 12th, 2024. So Boris, welcome back to the show. It seems that we've been blessed with an incredibly action-packed second half of the year so far, and even just the last 2 weeks brought us more market-moving headlines than we honestly could cover in just 10 to 15 minutes. So let's start with a big picture summary and maybe then work our way back through the recent developments. What's keeping investors awake at night at the moment?
Yeah, hi Alex, pleasure to be back. I think you're right about kind of mentioning that there has been a lot of macro uncertainty impacting both investors and businesses. And I think our job as analysts has basically become kind of guessing what the Fed might do next month. And the incoming data hasn't been particularly helpful either. I think the last job reports left investors scratching their heads, especially due to kind of this mixed picture it painted. But yesterday's higher than expected inflation report, so the CPI print, but also today's PPI print, I think they likely confirmed that the Fed will cut interest rates by 25 basis points next week. I think one point I always need to stress is that while the US, of course, is the most important economy out there, especially for global markets, but it's not the only one we are currently paying attention to. I think the macro uncertainty isn't tied to just one specific country right now. It's more structural. I think it's more global in nature, despite being driven by these idiosyncratic factors. So just to give you a couple of examples, we had a recent news flow on the German industrial complex that has been really horrendous. As of late, the country is going through structural change. We have high political uncertainty. Voters aren't happy with the current government. So this is all adding to this a bit of pessimism surrounding the European continent. On the other side of the world, you have Japan, where monetary policy is normalizing for the first time in really decades due to inflation picking up, pricing power picking up as well. And this is leading to the Bank of Japan raising interest rates. And then there is China as well, which continues to be plagued really by disinflation, both in terms of financial assets falling. So think about property prices, think about equity benchmarks being down, but also domestic demand being really weak. And my position, I think, as a global macro strategist, is to explain not only how these regional outlooks interconnect to each other, how we get the global big picture, but also how they, in the end, influence different asset classes for our clients and the broader market.
Well, it seems that the current macro environment definitely justifies your pay grade, Boris. But that was a really helpful introduction into why global perspective is really needed at the moment. So let's stay in the US for a bit. There was a lot of back and forth about the extent of the next Fed move, of course. Why do you think it will now be 25 BPS instead of 50 next week? Isn't there a narrative forming about the Fed being sort of behind the curve? And shouldn't policymakers cut sooner rather than later, given that fact?
Yes, I mean, perfect point, Alex. I think the narrative of the Fed potentially being behind the curve when it comes to the start of the easing cycle has really formed in the last, let's say, 6 to 8 weeks, mainly due to the softening of the labor market. And our conviction, as you know, we talked about it many times on the podcast, has really been that the labor market is not as tight as some might believe. And I think the recent data supports that in many ways. So job openings are down to the lowest level since early 2021. The hiring and the quits rate are below their pre-pandemic levels, but also wage growth is coming down, which I think in a sense is consistent with the Fed reaching its 2% target late 2025. So why then doesn't the Fed just commence with the easing cycle and start with a blockbuster 50 basis point cut? I think it's really down to these slight minor technicalities, if we call them that. So first, despite this clear weakening of hiring momentum, which I think Jerome Powell himself clearly acknowledged, there are still pockets of strength within the economy. Personal spending, for example, is still strong. The unemployment rate ticked down again in August, but also, as I mentioned, core inflation surprised the consensus to the upside yesterday, coming in at around 30 basis points month on month. Plus, I think the labor market report last Friday came just the day before the blackout period started for the Fed. So this is a time window during which Fed officials are not allowed to give speeches before the next FOMC decision. So there was not enough time to prepare markets, in a sense, for a jumbo rate cut, which is why I think 25 is now more likely, even though, as you know, I think the 50 basis point cut would have been the better choice for the Fed.
So from an outside perspective, my initial thought about this debate is, does it really matter if the Fed goes 25 or 50? What's your take on that?
Well, yes and no in a sense, because it doesn't matter for the signaling purposes of the Fed. How do policymakers want to be perceived by markets? As more hawkish, more concerned about inflation, then you go 25. Or as doves paying attention to the labor market and the slowing of momentum, then you would go 50. I think one argument against the 50 basis points some weeks ago was that would cause a panic in markets, because investors would think that what does the Fed know that we don't? Like this hidden information, does it justify going hard instead of just starting with 25 basis points? I think this has completely changed in recent weeks. Now a 50 basis point cut would, in my opinion, be more positive for markets than going 25, because it means the Fed has rightfully acknowledged the slowing of the labor market and the economy and is starting to come on top of the curve again, going in front of it instead of being behind the curve. So you see, I think the nuances really matter. But for the economy, as you pointed out rightfully, it doesn't really matter if they go 25 or 50. We have a transmission mechanism, or let's call it a lag, of around 12 to 18 months from policy to the economy. So 25 or 50, it's really just a drop of water to the ocean. I think what is important for markets is the bigger picture. So what explains why the dollar is down 4% since July? Why, for example, US yields have fallen so much to actually reaching new record levels this year, is that policy will become easier over the coming quarters. I think this is what matters. So more than 200 basis points of cuts are priced in for the next 12 months. And this is really a lot. And if equities can benefit from easier policy like bonds are right now, it will really be dependent on if the US falls into a recession or not. If it falls into a recession, then usually equities tend to underperform, even though the Fed is cutting interest rates.
Interesting. So it looks like the Fed really is finding itself at a crossroads, but over the longer term, markets do hope for a lot of easing coming their way. How has this impacted other regions and central banks?
So the Fed has basically given other central banks the green light to cut as well. Of course, in theory, every monetary institution is independent, of course, from their own government, but also naturally the Fed. And some central banks have already turned more accommodative, with the Bank of England cutting for the first time this year. The ECB today cut the second time of the year, and the Bank of Canada actually eased policy the third time this year. But in practice, easing policy for a longer sustained period of time, as the Fed stays neutral or even tightens policy, is not really an easy feat to accomplish. So the Fed pivoting, hopefully next week, is a good sign for risk assets. And it definitely is, I think, needed given the industrial recession in Germany, in China, and to a lesser degree in Japan as well.
Great. So I'm glad you mentioned those countries. You had some really insightful research pieces out this week talking about the structural change happening in all of them, I believe. So can we kick off with Germany? How right is the doom and gloom crowd when it comes to the Germany's outlook?
Yeah, well, I think it is a somewhat justified pessimism. So talking to our clients, looking at business and consumer surveys is really helping gauge the sentiment towards the country. And I think the short-term outlook isn't great. Germany's competitiveness has really suffered in the post-pandemic era. I think growth has lagged its G7 peers. Productivity has been lagging as well. But that in and of itself wouldn't be cause for alarm per se, because you can see it as a cyclical downtrend. It's that companies and businesses alike are now questioning let's call it the viability of the German growth model that has been sustained over the last couple of decades. So Russian energy has vanished as being kind of the cheap source of the German industrial complex. China has become much more competitive in the car making industry, but the US as well has started going against the tide and introducing these industrial policies to the detriment of Europe. And we are seeing the struggles of Germany play out. So it doesn't help that the news flow as well, so the short-term cyclical news flow this week has been, as I said, horrendous. We had UniCredit, the Italian lender, acquiring a 9% stake in Germany's second largest lender, Commerzbank, seemingly without the government noticing, which is never a good sign for them from a PR perspective. You had BMW recalling 1.5 million cars over, I think, bad brakes, and has therefore cut its outlook for 2025. And Volkswagen, Germany's largest car manufacturer, of course, is also considering closing some of the domestic plants for, I think, the first time in its history. And this just adds to, I think, the overall bigger picture of growth and the outlook remaining weak. We also had the industrial production being, I think, down 26% below trend. And productivity, as I said, has stalled as well for the years. And this all ties into this bad picture that I think investors have over Germany and Europe. And it doesn't help that elections in Germany are coming up next year. So this is definitely something we will have to watch going into 2025.
Yeah, really interesting scene going over there. So obviously 2024 continues to seemingly be a rough year for Europe's largest economy, that being Germany. What about China? We can't turn the other way from them.
Yeah, I mean, China is, in a sense, much more important than Germany for the global economy, especially for the US. China produces more manufactured goods than the next 9 countries combined. It has become the largest car exporter in the world as well last year. But the country is still plagued by weak demand, falling equity prices, the ongoing property crisis. So we had this the period of, let's say, 3 to 4 years of asset deflation, which is a big topic given that it's the primary source of wealth in China, meaning equities and housing. And I think given this cyclical downtrend, most analysts covering Chinese macro and monetary policy have actually been puzzled by the lack of stimulus introduced this year from Beijing. But what I've been recently arguing is that both fiscal on one side and monetary policy on the other just don't have the firepower they once have. So I laid out a couple of examples of why that is in my piece. So first, financial conditions are already as accommodative as they can be. Bond yields are the lowest on record. Official lending rates are at record lows. The reserve rate requirement is the lowest since 2007. Chinese private debt to GDP ratios are approaching levels not seen in Japan in the 1990s crisis. And finally, if you talk about the budget deficit, how much can fiscal stimulus really do? Budget deficits have averaged just shy of 7% in the years following the pandemic. So policy is supportive by any stretch of the imagination, in my opinion. It's just not enough to bring back these growth levels we are used from China. And maybe this is something investors have to get used to in the coming years.
So hearing all that, it does seem that the U.S. slowdown is somewhat mild compared to what is going on in Europe and China. So maybe as a last question, why is the dollar then still flat on the year?
Yeah, I think that is an interesting question because I think that the Fed and these expectations of significant easing in the U.S. are basically overshadowing all those regional outlooks. The euro is up year to date, given again that the Fed has overshadowed what has been happening with the ECB, but also because the Japanese yen, which carries a large weight in the US dollar trade index, is currently going through a major period of strength due to, as I said, the reflation of the economy, the Bank of Japan raising interest rates again. And the yen is not only up against the dollar, it's up against 98% of all currencies since July. So virtually all currencies are in the major category. And those two factors, the Fed overshadowing other central banks and the yen being up so much, I think this is what has led to the dollar repricing lower in the second half of the year, which is why I think it's important to mention the Wall Street consensus still sees the dollar continuing to depreciate over the next 6 to 12 months. I think our view is mildly less bearish on the dollar. We do think that most currencies will appreciate against the greenback, but not to the extent that is currently, I think, priced in or seen as the main consensus.
Understood. All right, Boris, thanks for joining us today. We'll check in with you in another 2 weeks. Appreciate your time.
Thanks, Alex. Always a pleasure.